Welcome to another episode of Thailand Truth Talks. This episode comes directly from your comments, questions, and concerns. Messages from viewers asking whether foreign retirees here in Thailand could be hit with double taxation on their income. It's a complicated and emotional topic, especially for people who have worked their entire lives, paid taxes back home, and dreamed of spending their later years peacefully here in the land of smiles. So today, I decided to dig deep. This video isn't sponsored, and I'm not speaking for any government or financial institution. I'm doing this research for you and for myself, because I'm also a prospective retiree in Thailand. I want to understand exactly what the law says, how it's being interpreted, and what's changing beneath the surface that could affect us all. Whether you're already retired here or just thinking about it, this issue touches every foreigner who plans to make Thailand home for the long haul. Many of you who follow this channel know that I make these videos because I despise injustice. I believe in fairness, transparency, and accountability. And unfortunately, those values aren't always easy to find when it comes to complex tax policies and bureaucratic decisions that quietly reshape people's lives. My goal is to expose the truth, explain it clearly, and show how it really affects the everyday people behind the headlines. The retirees living on fixed incomes, the couples who built their dreams here, and the millions of us abroad who one day might do the same. I also do this for friends and family, the people who might one day join me here, or who simply deserve to know what's really happening beyond the tourist brochures and social media myths. Because what happens in Thailand's financial and immigration policies doesn't stay in Thailand. These changes ripple outward, shaping global retiree migration, affecting local communities, and influencing the choices that each of us has to make. In this episode, I'll walk you through what Thailand's tax agreements with other countries actually say, how they're being applied in practice, and where confusion and misinformation are causing unnecessary fear. I'll also look at the deeper questions. Why now? Why is this issue suddenly gaining attention? And is there more to this policy shift than meets the eyes? As always, I encourage you to share your experiences in the comments, where you're from, how your home country taxes your pension, and whether you've encountered any conflicting information here in Thailand. Together, we can build a clearer picture and hold the system accountable through collective awareness. So let's get into it. The truth about double taxation, how it could affect your retirement dreams, and what you can actually do to protect yourself. This is Thailand Truth Talks, and as always, I'm here to uncover the truth, not just for clicks, but for justice. Today, we're diving deep into something that affects every single foreign retiree in Thailand, but that most people don't fully understand until it's too late. Tax agreements. Specifically, we're going to examine exactly what happens to your retirement income when you move to Thailand from the United States, United Kingdom, or Australia. Now, I know what you're thinking. Another video about taxes? This sounds boring. But stick with me, because what I'm about to show you reveals something much bigger than tax rates. The data we've uncovered tells a very clear story. Thailand is systematically restructuring its entire approach to foreign retirees. And if you're not wealthy, you might not like what we've found. Over the past few years, Thailand has been making a calculated shift. They're moving away from mass tourism and middle-income retirees toward attracting high net worth individuals. The question is, are they actually squeezing out poor to middle-income foreigners? Or are the rules changing beneath our feet? Let's look at the hard numbers, the official treaty language, and the actual tax laws to uncover the truth. The US-Thailand Treaty, the lucky Americans. Let's start with the best case scenario, American retirees. If you're from the United States, you've won the retirement lottery when it comes to Thailand. The US-Thailand double taxation agreement was signed in 1996, and it contains a provision that most American expats don't even realize exists. I'm talking about Article 20, which deals with pensions and Social Security. Here's the exact language that matters. Pensions and other similar remuneration paid to a resident of a contracting state shall be taxable only in that state. Let me break down what that actually means in plain English. If you're an American receiving a US pension or Social Security, and you're living in Thailand as a tax resident, you only owe tax to the United States. Thailand cannot touch that money. Zero Thai tax on your US retirement income. This is enormous. Let me give you a concrete example. Say you're 65 years old, living in Chiang Mai, receiving 30,000 US dollars per year in Social Security benefits. Under the US-Thailand treaty, you file your US tax return and pay whatever you owe to Uncle Sam. When that money arrives in your Thai bank account, Thailand has no claim on it. The treaty explicitly states that US pensions and Social Security sent to a Thai resident are taxed only by the US. This is a massive advantage. Think about it. You can live in Thailand with a lower cost of living, pay US tax rates on your retirement income, and Thailand can't double dip. For many Americans, Social Security income is partially or fully exempt from US federal tax anyway, depending on your total income. So you might be paying very little tax overall. Now, here's the important caveat. This applies to US source retirement income. If you have other foreign income, or if you're earning money in Thailand itself, different rules apply. But for your core retirement funds from the US, you're protected by this treaty. The question we need to ask is, why does the US have this sweetheart deal while other countries don't? Keep that thought in mind as we move to the next country. The UK-Thailand treaty, the raw deal for Brits. Now, let's talk about British retirees, and this is where things get significantly worse. The UK-Thailand double taxation agreement was originally signed in 1981 and has been updated with the multilateral instrument in 2023. You'd think after more than 40 years the UK would have negotiated good terms for its retirees, right? Wrong. Here's the brutal truth. Unlike the US treaty, the UK-Thailand treaty contains no general pension article. There's only a narrow clause that covers government service pensions, and that only applies to former civil servants receiving payment from the UK government for their past government work. If you worked in the private sector your entire life and you're receiving a private pension or even the UK state pension, you got no treaty protection. What does this mean in practice? It means Thai domestic tax law applies to your UK retirement income. According to tax experts who specialize in Thailand expat taxation, state and private pensions from the UK are assessable and taxable in Thailand when remitted. Let me repeat that. When you transfer your UK pension into Thailand, it becomes taxable income under Thai law. There is no exemption in the treaty, so Thailand can tax that income upon remittance. Let's run through a scenario. You're a British retiree, 62 years old, living in Phuket. You receive £1,500 per month from your UK state pension and private pension combined. That's £1,800 per year, or roughly 810,000 Thai baht at current exchange rates. When you transfer that money to Thailand, you must declare it as foreign income on your Thai tax return. After the standard deductions and allowances, let's say you have about 660,000 baht of assessable income. Under Thailand's progressive tax system, you'd owe approximately 30,000 to 40,000 baht in Thai income tax per year. Now, the UK will also tax your state pension if your total income is high enough. You can claim a foreign tax credit in Thailand for what you paid the UK, but you're still potentially paying more total tax than if you'd stayed in Britain. And here's the thing, you're definitely paying more than an American in the same situation would pay. This is the inequality that nobody talks about. British retirees are getting hammered by the tax system in a way that Americans simply aren't. Is this fair? Is this the welcome Thailand claims to offer foreign retirees? The Australia-Thailand Treaty, the confusing middle ground. Now we come to Australia. And this is where things get really interesting because there's a gap between what the treaty says and what actually happens in practice. The Thailand Australia Double Taxation Agreement was signed in 1987. Article 22 of that treaty deals with other income and includes this language. Items of income that dealt with in the foregoing articles may be taxed in the other contracting state only if it arises in that other state. If it does not so arise, it shall be taxable only in the state of which the recipient is a resident. Read that carefully. It suggests that Australian pensions which arise in Australia should be taxed only by Australia, not by Thailand. On paper, this looks similar to the US treaty. Australian retirees should be protected, right? Wrong again. Here's where theory meets reality. Thai tax advisors who work with Australian expats report a completely different practical outcome. Australian superannuation payments that are remitted to Thailand are treated as Thai taxable income. The tax experts are clear about this. Under the DTA, superannuation payments are considered taxable in Thailand if remitted. So what's happening here? The treaty language implies one thing, but Thai revenue authorities interpret it differently. In practice, Thai tax residents must report remitted Australian superannuation in Thailand and pay Thai tax on it, with a credit for any Australian tax paid. Let's look at an example. You're an Australian retiree, 67 years old, living in Bangkok. You're drawing down 60,000 Australian dollars per year from your super fund. That's roughly 1.4 million baht. When you transfer that to Thailand, you're required to declare it as assessable income. After deductions, you might have 1.2 million baht of taxable income. Under Thai tax rates, you'd be looking at approximately 100,000 to 120,000 baht in Thai tax. Yes, you can credit whatever Australian tax you paid, but you're still caught in a more complex situation than Americans, and you're potentially paying more than you would if the treaty was enforced as written. This discrepancy between treaty language and enforcement is troubling. It suggests that Thailand interprets these agreements in whatever way generates the most tax revenue. The treaties might say one thing, but the Thai Revenue Department does what it wants. Now we need to talk about Thailand's domestic tax system, because this is where everything comes together and where the recent changes reveal Thailand's true intentions. Thailand operates on a remittance-based tax system for foreign income. If you're a Thai tax resident, which means you spent 180 days or more per year in Thailand, you pay Thai tax on two things: all Thai source income and any foreign income that you bring into Thailand in that tax year. For decades, there was a loophole that savvy expats used. The old rule was that foreign income only became taxable if you remitted it to Thailand in the same year you earned it. So retirees would structure their finances to bring in old savings, or they'd keep their pensions offshore for a year and then bring it in the next year. This allowed many people to legally minimize or eliminate their Thai tax burden. But in 2024, everything changed. Effective January 1st of 2024, Thailand imposed tax on all assessable foreign income brought into the country by its tax residents, regardless of when it was earned. Let me emphasize this. The deferral strategy is dead. If you bring foreign money into Thailand now, It doesn't matter whether you earned it last month or 10 years ago. If Thailand determines its assessable income, they will tax it. According to tax specialists, Thailand was historically an attractive destination for expats with substantial foreign sourced wealth, precisely because of that lenient remittance rule. But as of January of 2024, that advantage evaporated. The Thai Revenue Department eliminated the deferral loophole, and they did it deliberately. Here's where it gets even more interesting. There are exceptions to these rules. Certain government pensions and Social Security payments are exempt. For example, US Social Security is specifically exempt under the treaty we discussed earlier. But most private pensions, investment income, and retirement account withdrawals are not exempt. Let's talk about the actual tax rates. Thailand's personal income tax is progressive, ranging from 0 to 35%. Here's the bracket structure that matters to retirees. 0 to 150,000 baht, 0%. 150,000 to 300,000, 5%. 300 to 500,000, 10%. 500 to 750,000, 15%. 750 to 1 million baht, 20%. 1 million to 2 million baht, 25%. 2 million to 5 million baht, 30%. Over 5 million baht, 35% tax. There are also various deductions and allowances you can claim. A personal allowance of 60,000 baht, potentially a spouse allowance, and some other deductions. But the bottom line is this. If you're bringing in a typical middle-class pension of 1 to 2 million baht per year, you're going to be paying significant Thai tax unless you're American with US Social Security. Let me give you a real-world calculation. Say you're a British or Australian retiree with 1.5 million baht in annual pension income remitted to Thailand. After standard deductions of around 60,000 baht, you have 1.44 million baht of assessable income. Your Thai tax bill will be approximately first 150,000 at 0%, next 150,000 5%, next 200,000 at 10%, 250 at 15, 250 at 20, and then the remaining 440,000 at 25%, and in total your tax would be 225,000 baht per year. That's 225,000 baht, or roughly 5,000 UK pounds or 6,800 USD per year in Thai tax. This is on top of whatever tax you're already paid in your home country, minus whatever foreign tax credit you can claim. For middle-income retirees, this is a substantial hit. And remember, Americans with Social Security don't pay any of this. The inequality is staggering. The wealthy retiree visa, creating two classes. Now, let's talk about visa policy, because this is where Thailand's intentions become crystal clear. The tax situation is only part of the story. The visa rules reveal the master plan. Thailand recently introduced a long-term resident visa, or LTR visa, and has a specific category called wealthy pensioners. To qualify for this visa track, you need to meet the following requirements. Age 50 or older, minimum annual income of 80,000 US dollars, or if your income is between 40 and 80,000, you need at least 250,000 in Thai investments or property. Here's the crucial part. LTR visa holders are exempt from Thai tax on foreign income. Read that again. If you qualify as a wealthy pensioner under the LTR program, Thailand will not tax your foreign pension, investment income, or any other foreign source money. Now, contrast this with the ordinary retirement visa. The standard retirement visa requires age 50 or older, 800,000 baht in a Thai bank account, or 65,000 baht per month in documented income, about $22,000 per year. If you're on the ordinary retirement visa, you get no tax exemption. You're subject to all the Thai tax rules we just discussed. You're in the second class of retirees. Do you see what's happening here? Thailand has created a two-tier system. If you're wealthy enough to meet the 80,000 US dollar income threshold, Thailand rolls out the red carpet and exempts you from tax. If you're a middle-income retiree making 20,000 US dollars to 50,000 US dollars per year, Thailand takes its cut through taxation. This isn't speculation. This is official policy, documented in the LTR visa requirements published by Thai authorities. And it gets worse. Thailand has been quietly tightening other visa categories as well. The marriage visa, for example, now requires a 400,000 baht bank deposit or 40,000 baht monthly income, up from previous requirements. Education visas are under heavier scrutiny. Even tourist visa exemptions are being reformed. The pattern is undeniable. Thailand is raising its financial bar across the board, while simultaneously offering perks to high net worth individuals. They're filtering out the lower income foreigners and incentivizing the wealthy ones to come in. Is this a conspiracy? No. It's just policy. But it's policy that reveals Thailand's priorities very clearly. They don't want poor or middle-income foreigners anymore. They want your money, but only if you have a lot of it. Let's put Thailand's approach in context by looking at what other Southeast Asian countries are doing. Because if Thailand is squeezing out middle-income retirees, where are those people supposed to go? Malaysia is often mentioned as an alternative to Thailand. Malaysia's tax system is generally territorial, meaning they don't tax foreign source income, even when remitted there. A Malaysian tax resident with a foreign pension typically pays no Malaysian tax on that pension. This is a huge advantage over Thailand. However, Malaysia recently overhauled its MM2H retirement program, and the changes are shocking. The new requirements include offshore income of at least 40,000 ringgit per month, about 10,000 US dollars, fixed deposit of 1 million ringgit, about 240,000 USD in Malaysian bank, must purchase property worth at least 600,000 ringgit. Malaysia, like Thailand, is pivoting towards wealthy applicants. They've made their program inaccessible to average retirees. The difference is that if you can afford Malaysia's steep entry requirements, they don't tax your foreign income. Thailand taxes you unless you meet the even steeper LTR threshold. Singapore is another interesting comparison. Singapore does not tax most foreign source income received by tax residents. Foreign pensions remitted to Singapore are generally tax-free. Of course, Singapore has always been expensive and aimed at wealthy expats, but the tax treatment of retirement income is favorable. The Philippines has a retiree visa program that requires only a 10,000 US dollar to 20,000 US dollar deposit depending on your age and circumstances. The Philippines does not tax foreign source income, including pensions. This makes the Philippines significantly more accessible and more favorable for middle-income retirees than Thailand. Do you see the pattern? Thailand is becoming one of the least tax-favorable countries in the region for middle-income retirees. Its neighbors often provide better tax treatment, even if some have raised their entry barriers. The irony is that Thailand used to be the go-to destination precisely because it was affordable and welcoming. Now, Thailand is pricing out the very demographic that built its expat reputation. To understand why Thailand is making these changes, we need to look at the timeline. For decades, Thailand was the retirement paradise of Southeast Asia. The cost of living was low, the visa requirements were reasonable, and the tax system had that beneficial loophole where you could defer remittance of foreign income. Hundreds of thousands of foreign retirees flocked here. Many were on modest pensions, but they brought their money, spent it in local economies, and contributed to Thailand's image as a welcoming, affordable place. But something shifted in Thailand's calculus around 2020 to 2023. The government started talking about quality over quantity when it came to foreign residents. They looked at Singapore's model of attracting high net worth individuals. They saw the revenue potential from wealthy expats who could invest millions of baht in property, businesses, and Thai assets. The 2024 tax reform was the culmination of this shift. By eliminating the remittance deferral loophole, Thailand forced all tax residents to pay up on foreign income. By creating the LTR visa with its tax exemptions for wealthy pensioners, Thailand created an escape hatch, but only for the rich. In late 2024, Thai authorities floated a proposal for a 2-year grace period on the new tax rules for income earned from 2024 onward, suggesting enforcement might not begin until 2026. But here's the thing. Whether enforcement is strict in 2024, 2025, or 2026, the direction is clear. The rules are tightening. The definition of who's welcome in Thailand is narrowing. Some people argue that these changes are about revenue. Thailand needs tax income, especially after economic damage from COVID-19. But if that were the sole motivation, why would they create tax exemptions for LTR visa holders? Why would they make it easier for wealthy people to avoid Thai tax while cracking down on everyone else? The answer is that this isn't just about revenue. It's about reshaping Thailand's expat population. It's about attracting a different class of foreigner. What this means for you, the bottom line. Let's bring this all together and talk about what these tax agreements and policy changes actually mean for you, the potential retiree considering Thailand. If you're American, you're in the best position. Your Social Security and US pensions are protected by the treaty. You won't pay tax on that retirement income. However, you're still subject to the regular retirement visa requirements unless you qualify for the LTR visa. And if you have non-pension investment income or other foreign earnings, these could be taxed by Thailand if remitted. If you're British, you're getting squeezed. Your UK pensions are fully taxable in Thailand when remitted. There's no treaty protection. You'll pay Thai tax in addition to UK tax, with only a foreign tax credit to offset double taxation. Unless you're wealthy enough for the LTR visa, Thailand is a much less attractive destination for you than it was 5 years ago. If you're Australian, you're in a confusing middle ground. The treaty language suggests you should be protected, but in practice, your superannuation withdrawals are taxed by Thailand. You'll need good tax advice and potentially need to challenge assessments, but expect to pay Thai tax on remitted super unless you qualify for LTR status. For all nationalities, if you can't hit the 80,000 US dollar annual income threshold for the LTR visa, you're in Thailand's second class of retirees. You'll be subject to the full Thai tax system on any foreign income you bring in. Your tax bill could be substantial depending on your pension amount. Let's be honest about what this means financially. If you're a typical middle-income retiree with 30,000 to 50,000 per year in pension income, you could be paying anywhere from 50,000 to 150,000 baht per year in Thai taxes, assuming you're British or Australian. That's 1,500 to 4,500 US dollars per year. Add that to your living expenses, visa costs, and health insurance, and suddenly Thailand isn't as affordable as you thought. You might find that staying in your home country or moving to a more tax-favorable country like the Philippines or Malaysia makes more financial sense. Based on everything we've examined, let's project forward. Where is Thailand heading with its policies toward foreign retirees? The data points all trend in the same direction. Creation of special visas for high net worth individuals with tax exemptions, elimination of tax loopholes that benefited middle income retirees, tightening of visa requirements across multiple categories, public statements from Thai officials about seeking quality over quantity. It's reasonable to expect that Thailand will continue along this path. We may see further increases in the financial requirements for ordinary retirement visas, expansion of benefits for LTR and elite visa holders, stricter enforcement of tax collection on foreign income, possible introduction of wealth-based or investment-based criteria for long-term stay. Meanwhile, neighboring countries will continue competing for the middle-income retiree market that Thailand is abandoning. The Philippines, Vietnam, and potentially Indonesia will position themselves as the affordable alternatives. Malaysia, despite its own high entry barriers, will remain attractive for those who can afford it due to favorable tax treatment. The market is segmenting. Thailand is claiming the wealthy tier. Other countries are claiming the budget and middle tiers. If you're a retiree without substantial wealth, this trend is bad news. The Thailand you researched 5 years ago isn't the Thailand of today, and it certainly won't be the Thailand of 2030. Here's what we've uncovered with hard data and official sources. American retirees have a sweetheart tax deal thanks to their 1996 treaty. British and Australian retirees do not. Thai domestic tax law changed in 2024 to close loopholes and force taxation of foreign income. Thailand created a two-tier visa system that exempts wealthy retirees from tax while subjecting everyone else to full taxation. Regional competitors often provide better tax treatment for middle-income retirees. The conclusion is unavoidable. Thailand is deliberately restructuring its policies to favor wealthy expats over poor and middle-income foreigners. This isn't a conspiracy theory. This is documented policy, visible in tax law revisions, visa requirement changes, and official program launches. The Thai government has made a strategic decision to move upmarket. For those of you watching who are 55 plus, considering retirement in Thailand, and operating on a modest pension, you need to understand this reality. Thailand is not the bargain destination it once was, at least not from a tax perspective. Unless you're American with substantial Social Security income, or unless you're wealthy enough for an LTR visa, you will pay Thai tax on your remitted foreign income, and that tax bill could significantly impact your retirement budget. The question you need to ask yourself is, knowing all of this, is Thailand still the right choice for you? Or should you be looking at alternatives? I've given you the data. The treaties are clear. The tax laws are documented. The visa policies are published. The truth is in the numbers. What you do with the truth is up to you. Thanks for watching Thailand Truth Talks. If this information was valuable to you, hit that subscribe button. We'll continue investigating the realities of expat life in Thailand that other channels won't talk about. Drop a comment below with your own experiences or questions, and I'll address them in future episodes. Until next time, stay informed, stay skeptical, and make your retirement decisions based on facts, not fantasies.